are the resources owned and controlled by the firm. Examples are cash, buildings, and equipment. Under the assets, there are two types of assets. We have current assets and non-current assets. First, the current assets are assets that can be realized, collected, sold, used up 1 year after year-end date. Example, cash and account receivable. Next are the non-current assets. Assets that cannot be realized, collected, sold, used up 1 year after year-end date. Examples are equipment, furniture, and building. And in assets, there are also two kinds of assets. We have tangible assets and intangible assets. Tangible assets are physical assets or assets that can be touched. Examples are cash and supplies. Next is intangible assets. Our assets, of course, are non-physical assets that cannot be touched. Examples are trademarks and softwares.
Liabilities may also be referred to the promises that one will do in the future, like the promise, responsibility, or an obligation to pay for something, provide services, and so on in the future. So there are two types of liabilities. The first one is the current liability, which refers to amounts due to be paid within 12 months or 1 year. And under the current liabilities are the following. Accounts payable, it is when a business uses credit card to pay for something instead of using cash. And then the next one is the notes payable. It is when a borrower obtains a specific amount of money from a lender and promises to pay it back in the future, which is supported by a promissory note. Accrued expense payable are payments that a company is obligated to pay in the future for which goods and services have already been delivered but has not yet been paid. Example is salaries payable. And then the last one, we have the unearned income or unearned revenue. It occurs when a company receives the money before the money is being earned, or for goods or services that are not yet delivered to the customer or buyer by the company. On the other hand, the portion of liabilities that will not be paid within the upcoming year is classified as a non-current liability, and under it are the following. The first one, we have the loans payable. A loan payable charges interest and usually based on the earlier receipt of a certain sum of cash from a lender. And the last one, we have the mortgage payable. The long-term financing used to purchase property is called the mortgage. A mortgage payable is the liability of a property owner to pay a loan that is secured by property. From the perspective of the borrower, the mortgage is considered a long-term liability. So all these things say that I promise to pay or settle you in the future.
The third major accounts in accounting is the owner's equity. What is an equity? Equity is the residual interest of the owner from the business. This means that it was to remain or the profit of the owner from the business. And to be able to get or sold for the equity, you should deduct the liabilities from the assets. Under the equities, we have the capital and the drawing. Capital is the value of cash or other assets invested in the business by the owner of the business. The second one is the drawing. Drawing is an account withdrawn by the owner for personal use from the business. The fourth major accounts in accounting is the income or revenue. Income or revenue is the amount received or earned by the business from selling something or rendering service. It also increases in resources resulting from performance of service or selling of goods. Examples are service revenue for service entity, sales from manufacturing and merchandising company. Remember, income or revenue increases equity. The last and fifth type of major accounts is the expense. Expense is the amount consumed or spent to operate the business. It also decreases in resources resulting from the operations of business. Examples are salaries expense, utilities expense, and rent expense. Remember, expenses decreases equity in accounting equation.
Chart of accounts. Chart of account is a list of all the accounts used by a company in its operations. It functions as a guide to the accountant or bookkeeper in ensuring uniformity of and consistency in the use of the accounts in a recording business transaction. Chart of accounts helps to identify where the money is coming from and where it is going. Chart of accounts is also the foundation of the financial statements. Chart of accounts or the accounts included in the chart of accounts must be used consistently to prevent clerical or technical errors in the accounting system. Nevertheless, take note that chart of accounts vary from company to company. The contents depend upon the needs and preferences of the company using it. Accounts are classified into assets, liabilities, capital, income or revenue, and expenses, and each is given a unique account number. A coding system is used to organize the accounts. Typical accounts found in the chart of accounts are the following. First, under the assets, we have cash, marketable securities, accounts receivable, prepaid expenses, inventory, fixed assets, and other assets. Under the liabilities, accounts payable, accrued liabilities, taxes payable, wages payable, and notes payable. In the equity, we have capital and drawing. Revenue, service revenue, sales, sales return, and allowances. Expenses, cost of goods sold, advertising expense, bank fees, depreciation expense, payroll, tax expense, rent expense, supplies expense, utilities expense, wages expense, and other expenses. The chart of accounts usually includes at least 3 columns. First column is the account. Under the account is the list of the account names. Second is type, list the type of account, either asset, liability, equity, income or revenue, or expense. Third is the account code. Contains the code of an account based on its classification.
At this point, we will show you an example of chart of accounts. There are different chart of accounts, but we will show you a very simple one. But first, let us first know the steps on making chart of accounts. So first, or the number 1, we will create 3 columns. So we have 3 columns in our chart of accounts. Second, prepare the 5 major accounts, which are the assets, the liabilities, the owner's equity, the revenue or the income, and of course, last but not the least, the expenses. So it means we should identify our assets. What are our assets? And also we should identify our liabilities. Also the equity, the revenue, what are our income on that particular period. Our expenses, what are our expenditures or expenses. And of course, the third one, the third step, on the first column, we will put the account type. What are account types? Account types are what we call 5 major accounts, which are the assets, the liabilities, the equity, the revenue, and the expenses. There, so we're going to put in the first column the account type or the 5 major accounts. The fourth step, on the second column, we will put the account code. The account code or the number or the account number that depends on the company and be in order. But take note that the initial number of the 5 major accounts are different. Take note, for example, in the assets, the initial number of the assets starts with number 1. But when you go to the liabilities, its initial number is different. It's number 2. The same goes with the owner's equity, which is its initial number is number 3. And in the revenue or in the income, the initial number is 4. And in the expense, its initial number is 5. So that is the account code and the account number. But you should always remember that it should be in order. And in the 5th step, on the 3rd column, we will put the corresponding account name. So what is account name? Account name refers to the what kind of account type or what kind of 5 major accounts. Okay, so take note, for example, in the assets, its corresponding account name are cash, accounts receivable, and office furniture, and so on if you have to continue it. The same thing goes with liability. Under the account name, we will put accounts payable, the rent payable, and the notes payable. That also happens in equity. Its account name is JN Capital and the JN Drawing. In revenue, under the accounts name, we can put sales revenue. Then in expense, we put under the account name the salary expense, utilities expense, and the rent expense. However, there are bigger companies that require additional accounts. Because they are big, they are larger, they have a lot of accounts. So in the chart, those additional accounts can be divided into sub-accounts. For example, the company has different departments like administration department, service department, and marketing department. So the company has to pay salaries on each of these departments. So what is he going to do, or what should the president do in that company? What should he put in the chart of accounts? So in the chart of accounts, the company can put in the account name salaries expense, which is its sub-account is the administration. And under that, salaries expense again, and its sub-account is servicing. And under that again is the salaries expense, and its sub-account is marketing. And after that, we can already put the account code and the account type. So we are done in our discussion in Chapter 8, which is all about the 5 major accounts and the chart of accounts. We hope that you understand it very well, and we hope that you like it. Thank you so much, and good day.